Hey, everybody, and welcome to this week's Nasdaq Dorsey Wright podcast. It is Thursday, October 20th at the time of this recording. My name is Will Gibson, and we have a special guest this week, and I would say a friend of mine now, Brian Joyce, is on with us. You probably haven't heard from Brian Joyce, at least on our podcast before. So, Brian, awesome to have you on, and thanks for taking the time.
Thanks, Will. It's a pleasure to be here. A big fan of Dorsey Wright and all the work you guys do. And so this is my first podcast. So this is something to check off on the bucket list. But thanks for having me on. Appreciate it.
Oh, yeah. No, we appreciate it. We like seeing your work as well. And we've gotten to know each other a bit, at least over the past year or so, which has been really fun. You're a technicals guy. You have a lot of great experience around Wall Street, around different firms. So maybe for the people who aren't familiar with you, kind of what's your background, career? How'd you get to this point, and kind of what are you doing now?
Yeah, sure. So I've been in the industry over 20 years, and I started back in the late 90s on the buy side at Neuberger Berman, and within about 18 months or so was moved up to one of their trading desks covering internal money managers, primarily executing equity order flow, and eventually that seeps into executing option flow as well. Moved over to a different desk over there, prime brokerage, covering small hedge funds and family offices, small mid-sized hedge funds. And then around 2007, due to the merger with Lehman Brothers, what in hindsight probably was a good thing. A lot of the desks were let go, and I moved on to actually a sell side role covering large institutional investors. It was a small research boutique, Portalis Partners. Very interesting time starting there in March of 2007. We covered financials, large banks, brokers, mortgage companies. And so, and our head of research, Charles Peabody, very well known in the street, on the space. And so as the markets were imploding, so to speak, over the next couple of years, we largely were on the right side of that call. And so, unfortunately, as many people were being laid off in our industry, our firm was growing. As small as we were growing in size, and so managed to navigate those turbulent times pretty well. And so right now I've been at Nasdaq for about 6 years. Started here in 2016. I work on the market intelligence desk here, and I cover the financially listed companies and the SPAC companies as well. So certainly very interesting times. We speak to the senior management teams, the CFOs, IROs primarily, and basically we're here to help try to educate them and help them better understand what's going on in the trading in their stocks, the broader capital markets. Really, what they're trying to understand is what's going on amongst their shareholder base, looking for information outside of the quarterly 13F filings that come out, which 45 days after the end of each quarter. So they tend to be very stale information when they do come out. So any guidance we can give them as to what kind of activity is going on in their stock, what type of brokers, retail versus institutional, that's driving their activity. A lot of times these management teams, they have to answer back to their board why they're outperforming or underperforming. And so any information that we can help them with, if we can connect them to, other desks on the street, that's what we're here for. We also open up IPOs when they first trade. We had Prime Therapeutics Day IPO, and it did well. So we work with the underwriters there, try to help them understand what's going on in the building of the book before that first trade takes off. It's typically a very big volume, large volume trade. So we want to make sure that the underwriters have all the information, that they're clearly seeing what's going on the book, in the book, above and below that indicated price before they actually tell us to go ahead and open up the stock.
Wow. That sounds fun. Sounds like a lot of fun. And I know you've told me several times what you do. And I feel like every time you tell me, I pick up on a little something different. That's part of the role. So that's neat. And I know we've talked about a lot before. I've been in communication. You use a lot of technicals in your work, and you've kind of developed that tool set over your career as well. You got the CMT. When was that you went through the CMT program?
So I started following technicals around, I would say, 2011. So I had been in the industry for a while. I was, when I worked on the sell side at Portalis Partners, we were a fundamental research shop. I was a sales trader. I'd call around, summarize our analyst notes to traders, and you have to, be quick and brief on the phone or via email, because there's just so much research going on out there these days. And I just realized through that process that price action was was different than what necessarily sometimes the fundamentals were showing, or maybe there was the time frames were just not lining
Hmm.
up correctly. And I'd say around 2011, 2012, I started the process, acquired my CMT, I believe in 2014. So about 8 years or so, I've been the CMT charter holder.
Nice. Okay, very cool. Yeah, we like to, I mean, we're purely technical work, as you know. We don't knock fundamentals at all. We think it's very complementary to the technical side. It's 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 again very complementary in the sense that you can have a great company and a horrible stock, or you can have great stock and maybe a questionable company. So putting those two together definitely gives you a more holistic picture of what's going on in the market. I know technicals in this market have been really interesting. You've been seeing a lot of this hasn't happened since type of statements. I know we've been
Absolutely.
writing that in our reports over the past, feels like 9 months now. It's, this hasn't happened since 2011, 2008, 2016, a couple of times, 2020, most recently, in terms of whether it's market breadth, whether it's returns for various asset classes, leadership changes, relative strength, you name it. It's been either this hasn't happened since or first this year. So plenty of stuff to talk about there. And I know I want to get your thoughts on this as well. So people can hear. Starting on that, maybe just high level dinner conversation is the equity market right now. We know a lot influences the equity market via factors, economic factors, micro factors, but just high level equities right now. How are you looking at it in terms of we're heading into year end, almost at the end of October, historically a pretty seasonally strong period of the market. This week's been really volatile, still kind of tough to get a direction, but what are some of the key things that you've been monitoring right now?
Yeah, I feel like a lot of us on the street were, from a technical point of view, we're all looking at those June lows on the S&P 500, which I believe is about 3,500. I know we in this past month, these last few weeks, we did make marginal lower lows just below it. We hit the 50% retracement, which actually down there is where we saw that is the 3,500 level, 3,505. The June low is a little bit above that. So on the S&P 500, I guess in summary, I think we're at definitely a key inflection point here. As you noted, the volatility, particularly since last Thursday, when the CPI print came out, has just been wicked, 2% up, 2% down. Volatility, everywhere, particularly in FX and rates, has been very strong. But as sticking just to equities here, it wouldn't surprise me if we did have a near to intermediate term relief rally off this level. Nothing really would surprise me. Along with the June lows and the 50% retracement, also is the 200-week average. So we had that cluster of technical support right around 3,600 in the S&P. Where earnings are coming out, they're relatively positive. With some of the big banks coming out, and the airline stocks, I believe those were seen as positive as well. But there's just so much concern out there. I mean, it's such a different environment right now, and people hate to use that word this time is different, or that phrase. But if we look at the last 40 years, we haven't had inflation like this once.
Yeah.
So going back to the inflationary times of the 70s and 80s, maybe it's not different from there. But for most of us, we've never seen that before. So whether or not the thing is like, when have we seen the Fed, say they're looking to tighten financial conditions like this? And so what that essentially means is when credit spreads narrow, when the equities rally like we saw this summer, then we had Jackson Hole a couple of weeks later at the end of August, where the Fed is talking about, Powell's talking about causing pain for investors and businesses with higher rates. And so we're seeing inflation that just last Thursday, worse than expected. And that core inflation that everyone's focused on, I read a note today, the services part of that core inflation, services makes up 80% of the economy. And so core services inflation grew, I think, 0.8% month over month, highest monthly gain since like the early 1990s. So if we're going to take the Fed at their word, and we believe them when they say they're going to get that inflation rate down to 2%, or at least get it down to where the Fed funds rate is below the inflation rate, then we have to expect that the rates are going to continue to go higher. You would think that would take some more multiple out of the market. I think we're around 15.5 now on the S&P. And corporate earnings on that side, for 2023, I was looking the S&P 500 corporate earnings for 23. They're less than 4% off of their highs, which was projected, which I think peaked back in April. So we haven't really seen corporate earnings expectations come in for 2023 all that much. So there's the risk there for that to impact the market as well. And back to rates, we know the overnight Fed funds rate, the terminal rate now is at its highest that we've seen this cycle. It's looking about 5%, a little over 5% right now. So just at the beginning of August, that was at, the terminal rate was, I believe had a 3 handle on it. So,
Wow.
Rates have just moved, in the last 3 months alone since August 1st, we've seen a phenomenal move in rates. The 10-year went from basically 2.5 to 4.2% in less than 3 months. So really changes things.
Yeah, certainly. And for those that are watching on YouTube, we are putting some charts that Brian sent over. So if you want to see kind of what we're talking about and what he's been mentioning there, definitely check out the YouTube video. Brian, I want to revisit, you kind of mentioned that we're near the June lows. You saw a couple of breadth kind of washouts this year on several different occasions. So there is some clustering technical data points that we've gotten close to a couple of times, maybe some in that seeing as a catalyst to the upside. More so, do you make anything out of, because I know we got pretty close to our pre-COVID highs on a couple of the major indices. Like I think the Nasdaq Composite was pretty close. The S&P has been pretty close. Nasdaq 100 has what got also pretty close to its pre-COVID highs, January, early February of 20. Do you make anything out of that? I know kind of prior resistance becomes future support type of rhetoric. Is that applicable to those highs in your view?
Absolutely. I think the two major indices that have hit that February 2020 high has been the Dow Jones and the Russell 2000. I think the Russell has come down below it the most. Off the top of my head, I think the S&P was 3 to 4% away on the Nasdaq 100, maybe 7% or so away
Sounds
from
right,
it. So the Nasdaq 100 has fallen the most from the highs, but the Nasdaq 100 and the Russell 2000 were up about 145, 155% off their lows. So they had seen the biggest gains, and so thus far they've seen the biggest pullbacks. I'm not necessarily in the camp thinking that those February highs from 2020 are necessarily going to be the end all be all. As far as the lows in this market goes, would it necessarily surprise me if we do make lower lows? So prior support or prior resistance, future support. I think we have seen that right now in the short term for the Dow and the Russell. We haven't yet hit that with the S&P and the Nasdaq 100, but I don't know if that's going to be the low.
Mm-hmm. Yeah, no, that's fair. I mean, even to the upside in terms of we've held some key support, you've gotten some movements out of heavily oversold territory, but in our indicators as well, you haven't really seen a material change of uptrend yet. You haven't seen some notable higher bottoms put in place on some of the major index chart or clearances of major points of resistance. Even on a breadth study, participation, individual stock participation is still low right now, which I know you kind of had some thoughts on that as well. But now, at least the way we're seeing it, breadth is not at washout levels where you would succeed. Hopefully some type of near-term mean reversion would follow out of that. A lot of these are inching back towards, the bottom third of the readings and not the bottom 10% of the reading. So that's an element that we've been watching as well.
Yeah, it's, I like to follow other people's work when it comes to breadth. I look at plain vanilla 52-week highs, advanced decline line, look for those bearish divergences. I know the advanced decline line, for the S&P 500, it made a new 52-week low, I believe, just in the past week alone. We look at 52-week highs versus 52-week lows. There's very few stocks at all in the S&P 500. It's less than 1% making 52-week highs. Only 18% or so made 4-week highs. And we saw those rallies back in March and the rallies in August. That number got over 50%. So I know we've had some sell-off here recently, and regarding 4-week lows, 85% of the S&P 500 did make 4-week lows, which is a new low in that metric for this year. So there's no bearish divergence or bullish divergence there, I should say. And we have seen that metric get lower at prior market sell-offs in March 2020 and December of 18. It was about 95% of the index was making fresh 4-week lows. It was a similar level in 2015 and 2011. So as you noted, we haven't seen a washout level based on that metric. And when we look at the prior bear market, I know they say March 20 was a bear market, but it was so quick. I mean, the NDX was down 35% that month in March of 20 intra-month, but month over month, it was down maybe like 5%. It was just so quick with the massive amount of intervention we saw at that time. But when we had in 2008, when we saw the breadth readings this bad, the low in the breadth reading was about 5 months before the low in the actual index. I believe it bottomed in October of 2008, and the S&P bottomed in March 2009. So, I definitely monitor the breadth metrics. I don't put too much weight in them as far as my overall outlook. At least at this point, I'm not seeing anything that would tell me that we've had a big washout, and we potentially could see a significant low in the marketplace in the equities.
Mm-hmm. Yeah. I know even at least over the past 2.5 years or so, we've gotten pretty accustomed to V-shaped bottoms where you got a quick, moderate washout, and then you kind of kept on going from there. It's been a long time since you've actually seen some bear market rallies, and you've seen indicators chop around in low field position, like on our platform, whether it's bullish percent charts, or we have some high-low charts that we put out as well, 10-week readings, so the percentage of stocks above their 50-day moving average, things like that. We got used to seeing them go under 30% or go under 20%, and then pretty much just shoot right back up along with the market. But now you're seeing a lot of consolidation of those indicators down there, which is characteristic of some major market meltdowns over the past 20, 30 years. Just recently, we haven't been accustomed to that. So, definitely relate on that front. Maybe talking a bit different or bringing in some other asset class focus. We know equity's been pretty sensitive to a lot of other areas. You mentioned rates has been a big one. I know the dollar has been in an area that we've been watching. I think over the past couple of months or maybe more, it's almost been the case where if you saw the dollar start to soften, equities tended to like that, or coincidentally firming up a bit. Any thoughts about the dollar, its effect, kind of technical movements there?
Yeah, I mean, so clearly, a strong uptrend this year in the DXY, up about 18% on the year. I think the prior record high, going back to the early 1970s, was about 15%. So, as you noted earlier, there's been a lot of these. Haven't seen this kind of move in so many years. FX, especially, whether it's the DXY, which is dollar yen, which is also, you've seen the Japanese yen, having its worst year on record, falling over 25%. It's just been a phenomenal move. And I would just say that what I'm tracking is this uptrend in the dollar. We've been consolidating the last 4 weeks or so. It looks very constructive to me. There's nothing concerning. If I was a dollar bull, that would be into that setup, into that trend. The 50-day moving average has been a pretty reliable level for the DXY to pull back to, and so we're still a fair amount above that right now. So nothing concerning there. If you look at a longer term chart, I'm pulling this up on my laptop over here as we speak. I think that 120 level seems like a logical level to have an expectation as to where this can go. That represents the highs from 2000, 2002 area. Would not surprise me at all to see the dollar get up that high. And the Japanese yen, it's unbelievable. It's just, it continues to weaken and weaken. What's really interesting on that setup, if you look at the quarterly period chart, which is almost as long term as you can get, it looks like this thing is, in the early stages of making a move. Let's say early to mid stages. So this, I don't know if you'd want to call it an inverse head and shoulder pattern on that quarterly period, but it's certainly a glaring setup.
Yeah. Looking at the dollar, again, I pulled it up on our system as well. To your point, still looks pretty constructive right now. If anything, we're forming a triangle pattern on the point figure chart. So a move to the upside would be a bullish triangle pattern for the US dollar, which is a continuation positive movement there. So really the first level of support we have is about 110, and then 109.50 would be your first break and sell signal. The dollar on our default trend chart here hasn't given a sell signal since November of 21, December of 21 area. So it's been quite a while, and even one sell signal on that chart probably wouldn't change the whole trend of this for now. So a lot of work to do on that front. I think that's kind of weighed heavy on maybe commodities lately, seen a bit of softening there. Natural gas, energy, we'll kind of touch on that a bit later on a sector front. But before we get to that, anything else you want to touch on currency-wise? Did you want to mention anything else rate specific? I know that was kind of added in so far in the discussion.
No, I mean, I'm not. I don't track the various pairs all too closely. I look at euro, dollar, DXY, Japanese yen the most. We all have seen what's happened with sterling in the last month. The prime minister today just stepped down as well, so that's been as volatile as you could expect as well. Just overall, the volatility in this space has just been extreme. Again, there's just so much intervention, and it's what we have going on this year, I guess, is best characterized as a reversal of the currency wars that we saw coming out of the last 10 years following the global financial crisis, which was the race to the bottom. Now with the Fed jacking up rates as strong as it is, 75 bips expected next meeting, potentially 75 after that. And the terminal rate now expected to be about 5% for March and May of next year. Other central banks are just being forced to keep up and raise their rates so as not to see their currencies deteriorate any further. It's been a tough game to watch the central banks play, so to speak.
Yeah. I mean, it's been tough for investors, fixed income investors as well, equity, of course, but fixed income too. And we've talked about this a lot this year. There hasn't been that typical kind of downside buffer or exit door to go towards, meaning, and you kind of saw this play out in a lot of the sentiment polls, I think, where you were looking at bearishness for investors, but then you looked at allocations for those investors, and their allocations to equity were still much higher than you would expect, given how bearish the readings were. And we were thinking, well, there's probably not a ton of places to go. Typically, that equity allocation will get filled by moving to fixed income or moving to another asset class that could offer some shelter outside the equity market, but there hasn't been that this year, largely due to fixed income. We have a lot of fixed income groups that we track on our system, and they are pretty much all, except for like floating rates, some tips, and then like inverse fixed income, have been ranking beneath cash for most of this year, saying that you're better off to be sitting in cash on a relative basis. So yeah, that's been really tough to navigate. And I think
the one other thing I would say about the FX is I wonder if the strong dollar has been a relative tailwind for smaller cap stocks that have less exposure to overseas sales. We saw that ratio bottom back in, I think it was January, actually, where we saw small caps with the S&P bottom, and they've kind of been in a sideways trend now. I know a lot of technicians out there waiting to see if this sideways range that's been in place for most of this year. Whereas if small caps can break out to the upside, I think maybe the strengthening dollar has been more of a headwind for the larger cap multinational companies in the S&P 500.
That makes a lot of sense to me. That makes a lot of sense because we're looking at like the Russell 2000 that's put in some higher bottoms that held above its June low. You look at participation within small caps via like our bullish percent readings; those have been more resilient than a lot of the large cap space. So I think that thesis kind of checks out from what we've seen as well. That makes a lot of sense to me. Cool. Let's see, Brian. Anything else? So rate wise, I think we hit on that. Do we want to move over to some thoughts on sector movement now? Participation there, stuff to look forward.
Yeah, on relative strength, there's not many sectors doing well, right? So we know energy is doing well this year, healthcare is doing well, energy recently is still doing well, despite the fact that oil is trading lower. So I think that's a very positive signal. Equities, there's that old adage saying equity leads. Well, in terms of gold, the gold market, I used to always hear equity tends to lead the metal. So as it pertains to oil, maybe equities are leading, the underlying commodity oil. So we'll see if that's the case going forward. But we are seeing that move higher in oil services, exploration and production companies. And that's despite the fact that we've seen vicious volatility this past week or so. So I think that area looks constructive. I think one of the big themes this year has been that transition from growth to value. And when you look at, say, the growth over the value index, it's similar to what we see if you look at, say, technology over the S&P 500. So if we look at technology over the S&P 500, that's a very interesting setup to me, because you can go back to essentially 2006 when that ratio bottomed. At least since 2012, you could see a very strong uptrend in technology versus the S&P 500. And now the last 18 months or so, we're seeing clearly what to me looks like a clear topping kind of pattern. And this past week, with the underperformance in the tech sector, it's now testing the lows they made in 2021. So, I would be concerned, about that area. I know technology has already sold off, a lot, but on a relative basis, if you look at that tech sector of the S&P 500, to me, it's very toppy. And as that pertains to growth versus value, the technology makes up 43% of the Russell 1000 growth index. And so if you were to see, that roll over, that relative strength of tech versus the S&P, I would expect that the ratio of growth over value will do the same thing. Coming into 2022, that was one theme that I was looking at, because growth had outperformed value for 5 straight years, ending 2021. The prior record, so this is the Russell 1000 growth over the value index, which goes back to the late 1970s. Prior to the end of 21, it's never outperformed for more than 3 straight years. And then if you look at the last 8 months of that outperformance, that hit extreme levels, which was really the first 8 or 9 months of 2020, right as we're going through the heart of the COVID period, growth was outperforming value by 4.5% a month for 8 straight months on average. So, and if you went back, 15 plus, almost 20 years, value didn't do that for one single month over the last 15 to 20 years, and growth did it for 8 months in a row. So you had that parabolic move in the ratio, ending 2020, let's say it's called November 2020, and then you had this large 18-month sideways, what now turned out to be a double top pattern. And so we broke that support level in May of this year, of 2022. It surprised me that I've seen some people trying to pick the bottom in growth and technology, given that particular setup, because when you have a big long-term trend, like a 14-year trend, and then a large 18-month consolidation, what looks like a topping pattern, which confirms on the breakdown, even though it rebounded back into the pattern, so to speak, I bet you can see that clearer on the X's and O's in point and figure. To me, that was just, that was your chance, for investors right there to, rebalance, so to speak. And so we are seeing that roll over right now. It hasn't yet made fresh lows versus what we saw at the midpoint of this year. But that could be something we see in the future.
Yeah, and you had a great chart on the note of tech outperforming for so long. It's become a huge weight in the S&P, roughly 26% right now of the index. So you see tech struggle, that's going to be a pretty big weight on your cap weighted equity indices. And the chart that I was referencing here, the elephant sector, or the anti-elephant, or whatever it is, energy being so small in the market, has done so well. And you had this great chart about the composition of the index being tech growing in weight and then energy kind of falling in weight. But this year you've seen the biggest weighted sectors, for the most part, be the biggest underperformers. And then some of the smaller weighted sectors be some of the better performers. Energy being a huge standout. As you mentioned, a lot of those equities still look pretty constructive to us as well. Apart from like crude oil itself, the commodity, we're still seeing that kind of struggle to gain some ground, but energy sector as a whole still atop of a lot of our rankings, holds a big portion in a lot of our models, still a pretty firm overweight. So maybe something that we would think is that maybe it's a decent opportunity for active management right now, and then for the time going forward when your biggest sectors aren't working the way they used to. So if you can be tactical, if you can be nimble, if you can overweight areas that are small, maybe that's an opportunity to outperform.
Yeah, so right now I think energy is about 5% of the index. I think it was down as low as 3%, in late 20. The recent high for energy was about 16%, 15, 16% in 2008. That's been the highest since 1990. I think if you went back to the early 80s, I think you could maybe even see it higher. I guess what the S&P has going for it is that healthcare is, I believe, the second biggest weighting at about 15%.
There we go. Yeah.
And then also going for it is not having a bigger weighting in real estate, particularly in the last month. Real estate has come in quite a bit, those REITs. So I think that's less than 3% of the S&P. So I guess it all averages out or levels out. If you're looking to, for alpha to outperform portfolio manager or the individual investor, you take your pick and, as to what you think, will do better, and you overweight or underweight whichever sector you have a strong bias on.
Yeah, for sure. I mean, this year it's been definitely avoiding the losers has paid dividends this year. And you mentioned real estate. I cover real estate, or kind of focus on that sector with a lot of my coverage, alternative assets, real estate, and the selling in real estate has been relentless. REITs, as you mentioned, in particular, I actually put a report out on this last week. And participation has just been abysmal. I mean, you're seeing less than 10% of stocks above their 50-day moving average, and that hasn't budged. I mean, even with some of these big updates that you saw, none of those real estate participation indicators have reversed up. So that's been a huge laggard in the market this year. Extremely oversold, I would add, but huge laggard. Healthcare, I'm glad you mentioned that. That's been a sector that's started to perk up a bit. A lot of those big cap healthcare stocks have held up pretty well. Another one that we've been looking at recently, and I think earnings kind of catalyzed this or focused our attention, has been the financial space. We saw some of those broader funds hold up a bit better. Community banks we've seen start to perk up as well. So maybe something to glean there technically, but maybe to be determined yet.
Yeah, I definitely like what we've seen in the last few weeks in the regional bank space. I don't think we've seen it across the entire financial space. A lot of those bigger mega cap banks, particularly with the business lines, the fee income business lines, deal activity has been weak, IPOs have been down, M&A has been down. But if you're talking about like your pure branch bank lenders, we're not yet seeing signs of credit risk or major credit concerns. Maybe in small buckets like auto lending, maybe certain areas of subprime are just starting to see delinquencies get worse. But you're not really seeing any big credit hits yet. So banks are certainly building up those reserves, but that's anticipated in the marketplace. And I don't know how much further they're going to have to go. So maybe it's 2 or 3 quarters out where they continue to build reserves. But if we look locally at the U.S. economy, so we have a lot of problems with inflation, this and that, but the employment numbers are good. So people are working, and I think as a whole, I think consumers continue to have cash balances that are higher than what they normally have. So, so credit looks good. There's still activity in the marketplace. I know housing is slowing down quite a bit. The PMI numbers are still coming out. I still believe services and manufacturing are above the 50 level, so they're expansionary. So maybe going forward, 2023, that'll be a different story. But at the moment, we have seen some good relative price action in the KRX versus the S&P 500. It's actually in the last week come right up to its prior relative highs from 2021, which was the highs that it made, following the COVID lows. So, maybe right now we see some back end filling going forward in this space. It's had quite a move It's virtually flat on the year, which is quite remarkable given the environment that we're in right now.
Yeah, yeah. I mean, if you're flat, that's a remarkable job so far this year. So I think that's definitely a space to keep an eye on as well. Well, Brian, let's see. Anything else? Any parting shots for the podcast this week? I feel like we've covered a lot of content from equities, rates, currencies, sectors. Any thoughts to leave the group with?
Yeah, no, I just want to say thanks for having me on. As far as the markets go, we've have sold off quite a bit. We're not seeing any significant signs of a major washout, as you noted. Your metrics would be far better than mine than what I'm looking at. So that's interesting to hear. In the near to intermediate term, anything's possible. We haven't had that strong rally or bear market rally, in a couple of months. Would not surprise me based on seasonal factors. Following midterms, for Q4, November, December, which, so Santa Claus rallies, things like that. Wouldn't surprise me to see that bear market rally, going into the year end, but it's not something I'm banking on. Like I said, as we noted earlier, the Fed's tightening financial conditions. If we see a rally in stocks, that's not going to make me at the moment think the worst is now behind us. The one thing I think maybe we haven't touched on is the geopolitical topic of everything going on around the world, which is basically impossible to forecast. But if things are improving on that front, right? Because things are bad. We've got China with the lockdowns, Russia-Ukraine war, European energy crisis. If there are some signs or some negotiations going on or anything on that front, on the policy front, where maybe things are going to look a little bit more optimistic, maybe where the first place we actually hear about it or see it is maybe it'll show up in the price action. We'll see some increased risk on type of behavior. So that's something I'm on the lookout for. I'm hopeful that the energy crisis in Europe, there could be some sort of resolution there, and some before the winter sets in. So we have that season's coming up now. So I'm hopeful by Thanksgiving there's some improvement there, and maybe the markets will respond positively to it. But again, I think the bigger backdrop is core inflation. What's the Fed doing? And if you believe what the Fed's saying, then I would still think there's plenty of reasons to be cautious in the longer term.
Yeah,
into next year at least.
Yeah, that's fair. I'm hopeful, but not holding your breath. Maybe would be the would be the summary. So, well, cool. I'll go ahead and wrap us up. But Brian, thanks again. Really appreciate it. Appreciate all the work that you do and the charts you share with me. Feel like every month or so. Really appreciate that. Everybody who's been listening or watching, we appreciate your attention. If we can be of any help for you during this market environment, don't hesitate to reach out. Other than that, thanks again, and we'll be with you again next week.
Okay, thanks, Will. I appreciate you having me on. Thanks a lot.